Hey everyone! Welcome back to Financial Futures. In today's video, we're diving into the big announcement coming up on September 18 from the Federal Reserve. This is a crucial one, and I've got all the important details you need to know about how this could impact your money, your interest rates, and your financial future. Let's jump into it. Before we get started, I want to say a big thank you to everyone who has liked this video and shared it with others. It really helps the channel grow and gets this critical information to more people. If you're new here or haven't yet subscribed, hit that subscribe button down below so you don't miss any future updates. Alright, let's get into today's topic. So, why is September 18 such an important date? Well, the Federal Reserve is wrapping up its next Federal Open Market Committee, FOMC, meeting, where they decide the future of interest rates. And trust me, this announcement could be a game changer for your finances. Whether you're managing debt, thinking of buying a home, or just trying to keep your head above water in this economy, this announcement will have an impact. For those of you who don't know, the Fed has been raising interest rates aggressively over the past couple of years, all in an effort to curb inflation. But what does this mean for you? If you have a credit card balance, a mortgage, or an auto loan, you've probably noticed your payments are a lot higher. Credit card interest rates alone have soared to 20–25% on average, up from about 14–15% just a couple of years ago. That's a massive increase, and it's hitting everyone's wallets. Have you been affected by these high interest rates? Let me know in the comments because I know I have, and it's not fun. Now, here's why this particular Fed meeting is especially important. There's a lot of speculation about whether the Fed will pause interest rate hikes, or perhaps, and this is a long shot, they may even cut rates. Why now? Well, this is the last meeting before the November election. If they decide to cut rates, it could be seen as a political move to make the economy look better in the short term. But even if they do cut, it's likely to be small, something like 25 basis points or 0.25%. But don't get too excited just yet. A 25 basis point cut is not going to change much for most of us. Sure, it might lower your credit card or loan interest rates a tiny bit, but it's hardly enough to make a significant impact. It's more of a symbolic gesture from the Fed, like, hey, look, we're helping. But in reality, it won't do much to put extra cash in your pocket. Whether the Fed pauses or cuts rates, it's going to affect all of us in some way. If you're carrying debt, especially on credit cards or personal loans, a rate cut could help you save a bit on interest. But if you're in the housing market, interest rates on mortgages are still around 7%, which is still incredibly high compared to where they were a few years ago. And if you're hoping for a bigger cut that'll significantly reduce your monthly payments, well, don't hold your breath. Even if the Fed cuts rates, it's unlikely to be by much, and inflation is still a major concern. The Fed's main goal is to keep inflation in check, so they're going to be cautious. Now, if the Fed does cut rates this time around, the next big question is, will they cut again in November? Or will they just pause and wait to see how the economy reacts? The next FOMC meeting is in early November, so we'll be keeping a close eye on that as well. But remember, the Fed's decisions are based on economic data like inflation, unemployment, and consumer spending. So if inflation stays high, it's less likely they'll keep cutting rates. Let's talk about inflation for a second. Even though inflation has come down from its peak of 9.1% back in June 2022, it's still a major issue. We've seen a lot of mixed economic data recently. Some reports show that inflation is cooling off, while others show it's still too high. So, the Fed is walking a fine line here. They want to keep inflation down without hurting the economy too much by raising rates too high. So, what happens if the Fed decides not to cut rates? Well, we could continue seeing high interest rates for the foreseeable future. That means higher costs for borrowing money, whether it's for your home, car, or even everyday purchases on your credit card. And as long as inflation remains a concern, the Fed is going to be hesitant to make any major cuts. But remember, the Fed's primary goal is to eventually bring inflation back down to their 2% target, and we're still a ways off from that. So, what can you do in the meantime? My advice is to keep an eye on your spending, manage your debt wisely, and be prepared for the possibility that interest rates may stay high for a little while longer. If the Fed cuts rates, it'll be a small relief, but don't expect any miracles just yet. Of course, I'll be keeping a close watch on all the details, and as soon as we get that official announcement from the Fed, I'll be sure to update you right away. Thanks again for watching. If you found this video helpful, don't forget to like and share it with someone who might benefit from this information. And of course, hit that subscribe button so you don't miss any important updates. Thanks for being part of the Financial Futures community, and I'll see you in the next video. Take care, everyone, and stay tuned for more updates as we head into what's sure to be a busy financial season. Stay informed, stay smart, and as always, I've got your back on all things financial.